debit and credit. So now there will be one account given to you. The left hand side of that account is known as debit and right hand side is called credit. Now there are certain golden rules of debit and credit for different accounts. Now this is traditional approach. So let's see what are the golden rules. As per these golden rules, you will be able to solve various accounting entries or transactions. Without this, to solve accounts will be quite impossible. So you have to learn these rules perfectly. So for the personal account, what is the rule for personal account? Debit the receiver, credit the giver. Means you will write the name of the receiver on the debit side and giver on the credit side. Then real account, it deals with the assets and property owned by the business. So debit side will contain debit what comes in and credit what goes out. So whatever asset comes into the business we will write on the debit side, and whatever goes out from the business we will write on the credit side. Then nominal accounts, here we will record debit all expenses and losses, credit all income and gains. So you have to learn these rules of accounts thoroughly. These are very, very important. Now with the help of this golden rules, we will see some examples. Now let's see one example. Here we have to solve the following transactions by applying rules of debit and credit, which we have seen in the previous slide. So what we have to find, two aspects means two effects, dual effects. Then two accounts we have to find, which type of accounts are involved in the following transaction that we have to find, and after finding those accounts we have to classify it as personal, real or nominal, depends upon its nature. So the first one here is to commenced business with cash rupees 20,000. So what happened here? Cash comes into the business. It is the first effect. Second is proprietor is a giver of the capital. Now whenever you start the business with cash, that is a type of capital which you receive in business. So cash will come in the business, and who gave you that capital? Proprietor is a giver of that capital. So accounts involved here, for the first one it is cash account. The second one here it is capital account. Then classification of account. Cash account is a type of property of a business, asset of a business, so it is a real account, and capital is given by the proprietor, so it is a personal account. Now what rules will be applied? Now for the real account, the rule is debit what comes in, credit what goes out. So here cash comes into the business, so we will write here debit what comes in. And for personal account, the rule is debit the receiver, credit the giver. So here proprietor is a giver, so the rule applied here will be credit the giver. So accounts should be debited. Debit what comes in? What comes in? Cash comes in, so cash account will go to the debit side, and credit the giver, so capital will go on the credit side. Then second is paid rent rupees 500 to Mr. Sharma. Now you are paying rent, you have paid the amount of rent. So rent is the first type of effect here. Rent is an expenses. When you pay rent, what happens? Cash goes out from your business. So two accounts involved here. First is rent account and second is cash account. Now rent is an expenses, so it is a nominal account. Cash is a property, so it is a real account. The rule for nominal account is debit the expenses and losses, credit income and gains. So here rent is expenses, so the rule applied here will be debit all expenses. And for the real account, here it will be credit what goes out because you are paying the cash. So debit all expense means nominal account will go to the debit side here. So rent account debit will be there, and on the credit side there will be cash account. Then third transaction, received commission rupees 5,000. So first effect is cash will come into your business, so cash comes in. Second is commission received in is as income. When you receive commission means you are receiving money, so it is your income. So two accounts involved here are, first is cash account and another is commission account. Cash is a part of real account, commission is a income, so it is nominal account. So real account rule here applied will be debit what comes in because cash comes in. And for this nominal one, the rule applied here will be credit all incomes because commission is an income for the business. So on the debit side we will write cash account, and on the credit side we'll write commission account. Fourth is purchase goods. Now see here you are purchasing goods from Mr. Verma rupees 10,000. So the first part is purchase is an expense. Mr. Verma is giver. Here there is no information that you have paid the cash. So we will assume that it is credit transaction. So in credit transaction, name of the person should be written. So purchase is an expense and Mr. Verma is a giver. Two accounts involved in this transaction. One is purchase account and next is Mr. Verma account. Purchase is an expense for the business because you are paying the amount, so it is a part of nominal account. Mr. Verma is a name of a person, so it is personal account. So the rule of nominal will apply here as debit all expenses, and for personal we will apply credit the giver because Mr. Verma is the giver of the goods. He gave you the goods. So on the debit side we have to write purchase account and on the credit side we have to write Mr. Verma account. Then fifth, deposited cash into the State Bank of India rupees 2000. So now you are depositing the money into the bank. So who received the money right now? Bank. Which bank? State Bank of India. So here State Bank of India is a receiver. Now you are giving your money to the bank. So we'll write here as cash goes out from the business. Two accounts involved here. One is State Bank of India account and another is cash account. State Bank of India is an artificial person account. So here we have to write here as personal account. Then cash is a real account because it is a property of the business. So the rules applied will be debit the receiver for personal account and credit what goes out for real account. So debit side we have to write State Bank of India and on the credit side we have to write cash account. So this is the way you can classify the accounts and two effects will also be done.